largely in line with the CNBC-TV18 poll. Well, on that note, let's go across to the HUL management, which is addressing the media now on the quarterly results.
2021, we have gained a substantial 200 BPS of corporate market share, and we continue to hold on to almost all of these gains despite heightened competitive intensity. Moving on to performance across the three segments, home care and beauty and personal care, which constitutes about 75% of our business, continues to see volume recovery and had mid-single-digit underlying volume growth. Consequent to price cuts taken during the year, USG for home care declined marginally and beauty and personal care remained flat. Foods and refreshment, on the other hand, saw a low single-digit decline in UVG, primarily due to the pricing taken in the year to offset impact of higher commodity cost. Consequently, USG was 1%. Margins in all three segments remain healthy, with home care at 18%, beauty and personal care at 26%, and foods and refreshment at 19%. We had a busy quarter with many innovations going into the market. Skin barrier care range from Simple, Sunsilk hair serum, Close-Up's new natural range of toothpaste, Knorr's Korean K-pop noodles, and Lakmé's range of makeup products were some of the key innovations in the quarter. Next, let me elaborate on EBITDA margin delivery for the quarter. At 23.7%, EBITDA has improved 10 BPS year-on-year. Gross margin at 50.6% has improved by 400 BPS from enhanced mix to premium portfolio and savings from our end-to-end net productivity program. A&P investments at 10.7% is up 270 BPS. We have deployed nearly 400 crores higher A&P than December quarter 22 as we continue to step up our investments behind brands and innovations. Employee benefit and other expenses at 16.3% is up 120 BPS. This is on account of investments in capabilities, royalty increase, and absence of top-line leverage. Moving on to our 9-month performance, our turnover at rupees 44,886 crores grew 3% year-on-year. EBITDA and profit after tax before exceptional items was up 6% year-on-year. Net profit was up 4%. Looking ahead in the near term, we remain cautiously optimistic. We expect gradual recovery in market demand to continue, aided by increased government spending, recovery in winter crop sowing, and better crop realization. Rural income growth and winter crop yields are key factors that will determine the pace of recovery. If commodity prices continue to remain where they are, we expect our price growth to be marginally negative. Our focus remains on driving competitive volume growth, stepping up investments behind our brands, and maintaining EBITDA margin in a healthy range. We continue to manage our business with agility and take actions to ensure long-term 4G growth which is consistent, competitive, profitable, and responsible. With this, we complete our prepared remarks, and now we take questions.
Thank you, Ritesh. Mangalam, would you like to ask the first question, please?
Yes. I was looking at your numbers, and they're rather weak. For the fourth quarter now, volumes are, in lower single digits here itself. And this at a time when some of the competitors are reporting stronger growth. So I have a two-part question. One, when do we see significant recovery in volume growth, and when does it, become independent of what the macro environment is? And secondly, gross margins have expanded by around 400 basis points, but all of them have been plowed back into ad spends. You are saying that you expect EBITDA margins to be in a comfortable range. If you could define that range for us. One is, when do we see significant volume recovery? And secondly, what is the EBITDA margin that you are comfortable with?
So if I can, Mangalam, take the first two parts and then maybe ask Ritesh to build on the margin and the EBITDA, the gross margin reinvestment and the EBITDA point. So as to sort of respond to your four-part question, is it okay?
Sure. Yeah, sure.
So if you disaggregate our growth, and as you said, it has been in low single digits in the last couple of quarters. The fact is that we're coming off a inflation-deflation cycle, where clearly the response to the investments and prices taking some time to come on account of a few macro factors, which we have to also accept as a part of the context we operate the FMCG business in. For instance, the slow recovery in rural, although of course urban continues to be resilient. So we operate within a certain context where we are continuing to be competitive. And as Ritesh mentioned, 60% or thereabouts of our business is still winning market shares. And we are coming off on a very, very high base of market shares of the last 2 years. So we remain strong, competitive, even though the top line numbers are what they are optically. As far as volumes are concerned, if you disaggregate our volumes by our three businesses, our home care, beauty and personal care businesses are growing in single digits, in mid-single digits, which is our second quarter in a row. So where we have taken prices down, we already start to see a price response to volume, and volumes are coming back, including, of course, being helped by the slow recovery in rural. On food and refreshment is where we have negative volumes. That brings down the total number. And that is largely because a lot of that, the categories we operate in, food and refreshments, still have faced high levels of inflation. To name an example, coffee, even on HFD. And in tea, we are seeing some downgradation. So it's still coming on the back of high prices, although the increase in prices is beginning to sort of narrow and stop. So we do expect over a period of time this will lap. But as we speak, food and refreshment is where we do see the volume drag, although the heartening fact is that we remain very competitive on value share across all our big categories in food and refreshment. So that is something that gives me quite a lot of confidence that what we're doing fundamentally are absolutely the right things. We are investing behind our brands. Our brand power is strong. Advertising, which had come down over the last several years of high inflation, is back. We are at very competitive levels of investment. Brands have good product quality, and I feel that our distribution and operational grip is tight. So we are going to come out stronger from this inflation-deflation cycle. And all we are doing around building our business for the future, such as investing in beauty care, capability, and all of that is going to basically pay off in good stead. So I feel quite optimistic that all of these investments are in the right places, and we will see, as macros tend to improve, some turn in volumes as well. I would ask Ritesh then now to complete the question on the margin and how exactly the shape of investments that we are currently choosing.
Sure. And Mugib, just to further build on the few more elements. So as Rohit mentioned, the home and personal care and beauty and entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum, if I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum. So there are parts of the business which have shown momentum very different. And of course, certain parts of the business are dependent upon the realities of inflation, which is a different cycle compared to the rest of the business. On a 2-year basis, the point I was making earlier, when markets are growing on volume now, it was declining in the base period. On a 2-year basis, FMCG is 2% CAGR growth in this quarter. Previous quarter, same number was 1%. So we have seen the CAGR 2-year moving from 1 to 2. And what has changed is 1 to 2 is rural, which same period in the previous quarter on a 2-year CAGR was -1, it's +1. So rural has added in last 1 quarter that momentum, which has gone from 1% cumulative CAGR to 2%. And coming back to your margin question, the point we have maintained that our focus remains on driving gross margin. First, we got our gross margin improved, and we brought it to the levels of pre-high inflation. The second job that we have, so remember pre-inflation, we had roughly 52% margin, gross margin, which we brought back. And our job now is to go back to pre-COVID levels, where we had 54% gross margin. And hence driving gross margin will continue to be a tremendously important focus for us. But equally, as Rohit mentioned, dialing up investments, not only in advertising, sales promotion, but also in product superiority, also in capability, remains squarely important, and leaning in as required on price and promotion, the way we have done in this quarter. When you saw in this quarter, our sequential margins for beauty and personal care and home care declined a little bit compared to the previous quarter, because we leaned in with product investments, we leaned in with price and promotion to ensure fuller volume recovery. So there are those puts and takes always in the P&L, and where our margins are today at 23.7, they are healthy margin. And we have maintained that the levels of margin that we have today, we are happy with this margin. Our single-minded focus is to ensure fuller volume recovery and keep dialing up growth.
Your assessment would lead to, growth in volumes once again from a macro standpoint. By when do you see recovery in rural?
Yeah, so there are two factors we called out which will really determine the pace of recovery. Number one is the rural income growth, and we know that that's an area which is important for us to see those markers. And second is the winter yield. In our view, those two elements should determine the pace of recovery as far as rural is concerned. And as you mentioned that overall, there are categories like FNR, which today we have lower single-digit volume decline because of commodity inflation. Now, the good news again is where we are today, we are seeing commodity inflation in food categories also moderating, which means now, like the balance 3 quarters of the business, even this part of the business then should start seeing year-on-year price inflation getting moderated, and then should help further recovery of volumes in that portion of the business as well. So those, I would say, are the two large elements which should determine sequential further recovery of volume from where we are today.
And just to follow up on that, the points that are within our control are invest in market development, sales, which have got the future spaces where we see consumer upgrading. We see high growth there already at about roughly 2 or 2.5 times our average. Premiumization, we see again, those segments are growing very, very fast. Innovations both in value and feature. So the job we as market developers and market makers is essentially to lean in on those vectors. And we see high level of productivity of doing that. And all of the investments and moves that you're seeing from us are essentially to put more focus around market development, premiumization, and innovation.
Thank you. Sesa, would you like to ask the next?
Right, so the numbers there, HUL missing some of those streets' expectations, but nonetheless pointing out that market development and premiumization will be the strategy for the company going forward. With that, it's time now to slip into a very short break, but coming up on the other side, we get you more news and updates that are affecting you as well as the markets.